Thanks for clicking. My name is Mark Mitchell. I'm a mortgage broker here in London, Ontario. CMHC, the Canadian Mortgage and Housing Corporation, released its quarterly report on the housing market assessment this week. The report noted that the country's housing sector had moved from a moderate to a high degree of vulnerability. So what I want to do today is go through key takeaways that can be gleaned from the report. There are a few key tidbits that do contain some good news, so we will go over those as well. And then we'll talk about what this means for the future. We will have more updates as they come out the rest of the week, as more and more real estate updates do tend to be released at the end of the month and the beginning of next month. Click like and subscribe to get those updates, but for now, let's just get into the report. So first off, I think the key takeaway from the report is that the new housing absorption rate is up to 85%. So that's the rate at which new houses that are built are sold right away, and that's at 85% of them are sold very quickly. The report notes that this is actually the highest level it's been since the early 2000s. So clearly, any new supply that's getting added to the market is being bought right up. I think it's really important, as we noted in the throughout the election, that housing supply played such a prominent role, and everybody's pretty much screaming that we need to have more housing supply in order to help with this affordability crisis, and this report just seems to definitely support that idea. Second, the report is predicting a 4% in GDP growth rate. We did note a few weeks ago that Canada's GDP had shrunk by 0.3%, but the report notes that it's predicting that compared to last year, we should be at an annualized GDP growth rate of 4%, which, if true, would definitely bode well for Canada's economy looking towards the future. There have been many fears that we would have GDP shrinkage and high inflation, which, as we've said before, is stagflation, not really what you want. So any news that we could be experiencing even higher GDP growth than initially anticipated, definitely great news. So that's a good news coming from this report. Third, Canada's fundamentals do seem to be improving. We are seeing a resurgence of the labor market, not so much for the part-time labor market and the 15 to 24-year-olds, but full-time employment is starting to come back, as is immigration. There was over 41,000 more people added to the country, more Canadian citizens, than the same period of time last year. So the report is noting that as these fundamentals come back, it's definitely good news for our economy. But, and this leads us to our fourth point, these fundamentals aren't enough to explain the high degree of price acceleration and overvaluation that we're seeing in Canada's housing market right now. And that's why the main reason why the report moves the Canada from a moderate degree of vulnerability to a high degree of vulnerability is that when it looks at the degree of how fast prices are going up and the degree to which the prices have gone up, those rise in prices aren't explained by those change in fundamentals. So as that disconnect becomes more and more clear between the fundamentals and the actual pricing, the pricing on the ground, that's why the report is saying that we're at a higher degree of vulnerability in our housing sector. And fifth and finally, and I don't think this is going to come as a surprise to anybody, especially not in my hometown of London, sales are far outpacing new listings. So this, combined with the new home absorption rate that we talked about at the beginning of the video, anything that comes onto market is selling fast, and that's really what is helping to lead to that high price acceleration and overvaluation as we continue to have a supply problem, which is really the key takeaway out of almost every report that comes out is the housing supply issue, in that we need more supply, that we just have too many people for the amount of housing stock we have. Yes, interest rates probably do have quite a bit to do with it, as they're still very, very low right now. But even as the stuff starts to go back to normal and people go back to work and maybe they don't need as big a houses anymore as they did during the pandemic, we're still seeing anything that comes on the market sells. So we do seem to not have enough supply for how many people we have, which is really, I think, what's the biggest key takeaway of this report. We will have more updates as they come out. This is the end of the month, so expect some more updates at the end of the week and the beginning of next week. Click like and subscribe to get those updates, and thanks for watching.